Good afternoon and good morning to some folks out there. Welcome to Baker Tilly's presentation today on the Inflation Reduction Act and what healthcare providers need to know regarding the act. Today is to learn about the Inflation Reduction Act and what it means for healthcare organizations. Personally, I'm excited about the Inflation Reduction Act and the opportunities both from a tax-exempt and taxable healthcare perspective. There are just so many opportunities out there, and tax-exempt organizations can take advantage of that as well. A lot of these opportunities can be tied into an organization's environmental, social, and governance initiatives. What we commonly refer to as ESG. So we're going to learn about the Inflation Reduction Act. We're going to understand the different technology and project types under the Inflation Reduction Act. We're going to identify what credits your organization may qualify for. And finally, we're going to determine the action items to effectively position your project to receive eligible credits. There's so much planning to do with these credits, timing, etc., and different opportunities to seize. And you have to get a bunch of different folks in your organization together, whether it be the CFO, construction folks, facilities management folks, etc., to all come together, understand what you have, what the opportunities are, and then, as I said, seize those opportunities. Next slide, please. So the Inflation Reduction Act, we're also referred to as the Act or IRA. It was signed into law August 16th, 2022. It's a pretty large act. It's 728 pages, and it really has a lot of funding in the act. $738 billion, to be specific, in the act, and $400 billion in new spending and tax cuts. So a lot of opportunity. They're trying to get organizations to do clean energy, different types of energy initiatives, and to give them a payback for doing those energy upgrades. Next slide, please. Okay, the $499 billion, if you look at it, 33% of it is in clean electricity tax credits. That's $165 billion. If you look down the list, 13%, that's on expanded ACA subsidies. And then you have the rest of the numbers there and the items there. They all deal with some sort of energy or environmental items. So, it's basically mostly for energy efficiency and upgrades to change the carbon mass of the United States. Next slide, please. So the relevant IRA 2022 loans and grant funding, there's $44 billion in grant and loan funding for qualifying clean energy and carbon reducing projects. I'm not going to go through each one of these, but you'll see, everyone has million next to it. Reclamation of water supply projects, $550 million. SLG grants, $1 billion. RD funding for electric loans for renewable energy, $1 billion. There's $9.7 billion in there too. Jewel is going to go through a lot of these opportunities in some of the later slides and talk about them and how your organization can take advantage of those. These for qualifying energy products tax credits. As I mentioned before, both for-profit and not-for-profit organizations are eligible for these clean energy tax credits. And this is a first time for not-for-profit organizations, as they have the ability to access direct pay tax credits for qualifying clean energy products. And what does that mean? An organization, a tax-exempt organization, they do improvements in clean energy projects. They get a refund from the IRS, even though they may not pay taxes, even though they may not file a for-profit tax return, they still will have the ability to get refunds from the IRS. And this will come out, on direct pay. And they're currently working on guidance on this right now. I mean, the IRS has already put out some guidance on the RIA related to wages, prevailing wages, et cetera. But there will be more and more information coming out. And you'll look to the right there. You'll see every organization, including individual households, can benefit from the IRA. And this could also be hospitals and senior living facilities that may be government owned. So there'll be some further information coming out about that as well. Next, we'll talk about the energy piece of the act. There's how big is it? There's wind, solar, hydro, biomass, combined heat and power, geothermal, carbon capture, electric vehicles, renewable low carbon fuels. In addition, the Act also expanded our Internal Revenue Code Section 179D for non-governmental exempt organizations. This is a deduction for reducing energy efficiency, and it can now allow tax-exempt entities to allocate the deduction to the designer of the energy efficient property and monetize it. So there's just a lot of different things in the RIA, and some of these, be honest with you, some of these, are new to me, different terms and everything. I went through and learned it, but we're fortunate to have Joel and his team that specialize in it, and it's a group of individuals that it's all they pretty much do, and they've been really busy lately trying to assess these for organizations. So once you do have an opportunity or want to discuss an opportunity, please reach out to us as soon as possible, and we can get back to you with the resources. Joel, I'll turn it over to you now to talk about the specifics of the energy piece of the act.
Thank you, Jeff. If we could go to the next slide, and specifics here is a relative term. Given the time allotted for this webinar, you could certainly spend a lot of time. As Jeff referenced, the IRA is over 700 pages, and there's just a lot. And to give some perspective, again, I've kind of lived in this world of renewable energy incentives and credits for better part of 20 years, 15 years at Baker Tilly, and this is by far the largest piece of legislation, most impactful, longest time horizon. As taking a step back, most of these credits are going to be available for 10 years. So if you think about historically, a lot of the credits have kind of started, stopped, sunset, rose again from the dead, depending on the administration. You really have the ability here to thoughtfully plan around what credits you may want to take advantage of in constructs with, a capital improvement plan that may already be in place and that sort of thing. So I wanted to make sure that overarching sentiment was not lost, and that this isn't a flash in the pan. This is legislation that's going to be impactful and resonate well into the next decade. So the idea of making an investment maybe internally or externally to get the appropriate stakeholders' heads around the legislation is not going to be an investment that won't go without a payback. You've got the time. So getting into the act, again, Jeff talked about some of the more traditional technologies and credits. Those have all been restored. In addition, there's a whole bunch of new stuff. And I'm not even an expert on all the stuff. I don't think anyone could claim to be, but there's biogas credits in place that are new. Electric vehicles and electric vehicle infrastructure are poised to do very, very well under the Act. A lot of incentives geared around manufacturing. I think related to this audience today, more incentives and more broader flexibility in terms of battery storage when you talk about resilient facilities, and depending on your location and interest in utilizing either fossil or renewable power with batteries. Just a wide variety of prior credits or existing credits that were kind of restored to their former glory and maximal value, as well as new credits. So next slide. And if you try to apply those within this infographic, you can kind of see we don't have all of those 70 credits that are in the Inflation Reduction Act on here, but you can see the broad applicability as it may relate to whether you're overseeing a single clinic, a large campus, administration buildings, any sort of real facility that has electric load, whether it be essential or non-essential facilities, can leverage the act in some way, shape, or form. I mean, I think that's the one constant as you're thinking about, well, I've only got a small clinic and, the electric demand isn't very large. There's opportunity there. There's certainly more opportunity as your electrical demand or load increases if you're talking about a large hospital campus on the other end of the spectrum. So you think about some of the technology, again, there's 70 credits in this act. Not all of them are really going to be applicable to hospitals and some of them or healthcare facilities. Some of them may be applicable in the future. Some of them might never be applicable. But some of the things that you want to think about, combined heat and power, solar, whether it be what we would call solar thermal for heating of processed water or electrical generation, energy efficiency, obviously, waste to energy, the EV charging, which I talked about, and storage as it looks to, whether you're looking for, well, we need more resiliency here because, we've had power outages, events that we've recently experienced here in Texas or wherever your location may be, or we've had events where that's become a real issue, or we want to be more sustainable. We want to introduce more renewables to offset our carbon footprint. And maybe it's some combination of both. So it's a very broad menu. Every situation is a little bit different, which is what I think makes this so interesting and such a powerful piece of legislation, is it really captures a lot of various opportunities. Next slide. So let's get into the meat of the dollars and cents of all of this. What are the credit? What does it offset? How do I build it up? And what is the intent behind the credit? So there's a lot of information on this slide. I'm going to try to keep it very, very simple. With the overall theme of this administration, with these credits more than any other prior credit regime, is this concept of what I call a carrot and a stick. So while the administration in passing this, in Congress passing this legislation, wants to promote the energy transition, they also want to do it in such a way that incentivizes manufacturing of the components that go into these this equipment in the United States, labor at prevailing wages, domestic content used, where these credits are incentivized to go in terms of the type of community that would be implementing them, and so on and so forth. So there's this very interesting, and this is a brand new regime. In prior years, it was, here's the credit amount, and you execute the project, and this is the credit you're eligible for. It's a little bit different and more nuanced with this legislation. So what they've done, and we'll talk about a very basic credit and probably the one most applicable to this audience, which is the investment tax credit, which sits in a section of the tax code. It's called Section 48. That base credit, and it's as it sounds, is a credit you can offset an investment in eligible renewable or energy property under the code. That base credit is 6%. So you think 6% credit, not very impactful. 6% on my $1 million investment. What's that? $60,000. What's that going to do in terms of really moving the needle or getting me excited? What the legislation attempts to achieve is by incentivizing you to take certain actions to build that credit up to, in some cases, as high as 70% from that base level of 6%. So you get these multipliers and bonus credits that can accommodate a much larger credit opportunity. So the base credit is 6%, as I said. If in the construction or implementation of the project, the energy project to be very specific, you use prevailing wage, Davis-Bacon wages, and you have a certain amount of hours that were allocated to the labor force that installed that project to apprentices, apprenticeship rules, you get a 5 times multiplier. That's the single biggest bonus introduced into this legislation. And that's what gets you back to what truly should be a base level of 30% in terms of I can offset 30% of every dollar of my qualified energy spend if I just use prevailing wage and apprenticeship or comply with those rules. Now you might say, well, that's, I don't understand that, or maybe I do, or this, that, or the other thing. Before getting too far down the line and worrying about compliance with that construct, we're going to talk about some various thresholds in subsequent slides about, essentially where you do and don't have to worry about complying. The other bonus, once we get to our 30%, assuming we meet prevailing wage and apprenticeship requirements, is something called domestic content. Back to what is this administration trying to achieve? Domestic content, you can move that 30% credit to a 40% credit purely by using 100% of U.S. sourced iron and steel in your project, and then 40% of what you would call the other stuff, the other components, need to be sourced domestically from the U.S. So depending on the technology, there may or may not be challenges based on the existing supply chain with meeting that threshold. But generally speaking, if you can meet that threshold or put that threshold onus upon your contractor who's installing the property to meet that threshold, you can get to 40%. That's a 10% bonus for domestic content. The next bonus that we run across is an energy community bonus. So what the federal government did is they said, if you're in a certain census tract, a certain physical location that meets these criteria, one of which is, are you in a brownfield? Most of you aren't going to have projects in a brownfield. Another of which is, are you in what's called a census tract or an adjacent census tract, which is, simply put, a way, the federal government for census purposes carves up the United States. If you're in one of those tracts that has had a coal plant or a coal mine close over the last 10 or 15 years, you're going to qualify for that bonus. Or if you're adjacent to one of those census tracts, you're going to qualify for that bonus. And then the third opportunity to qualify for that energy community bonus will be if your economy essentially has been or is over reliant on the fossil fuel economy. And there's some criteria that go with that I'm not going to get into for the purposes of this discussion, but that's essentially how you get that energy community bonus to knock you up to 50%. And then those are all entitlements. So if you take certain actions, if you're in a certain location, you are going to get that amount of credit. It's not a competitive grant. It's not a competitive credit like other credits. It's if you do it and take certain action and comply, you will get the credit. The last piece of bonus is something called environmental justice. And that is tied to establishing projects that essentially are in areas of low income or income data that's below the poverty level, or in the case of the 20% credit, if certain benefits of your project are then allocated, and when I say benefits, energy savings essentially, are allocated to low income people, and you can obtain a 20% credit. All of these credits, it goes without saying, can be stacked upon one another, which is why when I talk about 70%, you go back to, if I do this, and then I do this, and then I do this, and maybe if I do this, I can get as high as a 70% credit. Generally speaking, most projects are going to fall within the entitlement range of 30 to 50% of that project's eligible capital cost that can be offset by these credits. One important thing to note on the deduct side of the equation, for tax-exempt entities that traditionally use tax-exempt funding or are eligible to, you have to deduct that credit eligibility by a flat 15%, essentially, in almost all cases. So if you've got a 40% credit buildup, but you're using tax-exempt financing for the balance of the project, you're going to knock yourself down to 25%. And there's some strategies that go along with that we'll talk about and can be talked about, throughout kind of your capital planning if you were one of those entities that issues tax-exempt financing for projects. Next slide. There's also a production tax credit. I'm not going to dwell on this a whole lot, only because most of the technologies that are going to be deployed are going to be more valuable on an investment tax basis. But you have the ability to essentially elect a credit that is based off dollar of capital spent towards qualified energy property, or amount of renewable energy produced. And that's where the PTC comes in. It's not terribly applicable, like I said, to smaller scale what we call distributed applications, but it is available. And it would, I would go without, I would be remiss in not just making that apparent to the audience. So just know that there is an option to elect either PTC or ITC. ITC, there's a simple analysis you can do to kind of calculate net present value benefit of either option, and almost always ITC is going to win out in the situation that we're talking about here with the type of audience and projects they would deploy. So next slide. Diving into a little bit deeper, prevailing wage and apprenticeship. Again, essentially if you're familiar with and have received federal funding in the past or been awarded government funding or certain government contracts, oftentimes those awards come with having to comply with what is the local published prevailing wage. That's what gets you most of the way there to your 5% bonus I talked about to get you from 6 to 30%. They also tacked on something relatively new, which is apprenticeship requirements, which I'm going to talk about. What I mentioned before, none of this is really relevant so long as your project is smaller than 1 megawatt in terms of generation. And I would suspect a number of projects that the audience here would be evaluating are likely to be in that category. So before getting we need to understand everything there is to know about all these extra requirements to get me my 5% bonus, you're going to want to take a look. Am I really, is the energy generation or equivalent energy generation of the property I'm looking to install greater than 1 megawatt? If it's not, then you're automatically entitled to that 5 times bonus. You don't have to worry about compliance. Next slide. Prevailing wage and how prevailing wage works is essentially during the construction period, again, only for the energy property. If you're building a new clinic and the clinic's $10 million and you want to put solar panels on the roof and that's $1 million, let's just say, only the $1 million portion or the portion related to installation of that property would be subject to this requirement. But it is subject during construction, any alteration of the property into the future over 5 years, or any repair of that property over a 5-year, what's called a recapture period. So that is the requirement. And again, to distinguish, if anyone was thinking, well, if I've got to meet prevailing wage for my entire $100 million investment, I really got to think about whether I want to add a little solar to that project. No, it's really related to installation of that energy property. Next slide. Apprenticeship, fairly simple concept that's really tied to having your general contractor, as an example, have a certain number of the hours. In the case of projects that begin in 2023, meet this requirement of having at least 12.5% of those hours be performed by qualified apprentices. And again, the guidance, as Jeff articulated earlier, there's a lot of guidance that has come out. There's a lot yet to come out on specifics on complying with that, but that's essentially how that carrot in this case works, or stick, however you're looking at it, I suppose, is 12.5% in this year, 2024 and beyond. 15% of the hours, labor hours worked on that energy project have to be done by apprentices. There are some exceptions to the rules. Like I said, that some of that guidance has already come out. There's going to be more forthcoming, and we are happy to evaluate specific situations with you and your design build firm or your designer or planning as part of any upfront process, which, as Jeff said, we're doing a lot of that right now, as you can imagine. So next slide. So maybe getting into some specific examples, and one I've got a little bit of a bias towards is we talked about a lot of different technology, but to me, in terms of larger campuses or facilities in the healthcare space, combined heat and power, you've probably heard of, or maybe your facilities folks have at least thought of, because it can be fairly common depending on the specifics of the region you're in, the specifics of the needs of your facility, the layout, other things. So there may be some facilities folks, if you're on this webinar, or you may have facilities folks within your organization that are familiar with the old combined heat and power credit. This isn't a new credit, but what happened was, and I think it's gone a little bit under the radar with the Inflation Reduction Act, that base credit has been moved from 20 to 30%. So that's significant. A 20% increase in the base on a technology that with the 10% credit was already fairly economical in a lot of instances. That credit is now 30%. And as I articulated earlier, with the buildup, you can also get as high as 50% of that eligible cost funded via a refundable tax credit, or in the case of a not-for-profit organization, a direct pay tax credit through the IRA. So pretty impressive. For those of you that aren't familiar, combined heat and power is not necessarily a renewable technology per se. It's really a technology that takes typically natural gas, runs it through a internal combustion engine of some sort, provides electricity on site to your facility, either backup or firm power, and the heat that comes off that engine is then converted into useful heating for all sorts of purposes in your facility, or can be even used for cooling if you run it through something called a heat exchanger. So, not to get too technical, because I'm not a technical guy in the purest sense of the way, but we've done a lot of evaluations of these sorts of projects, and I see this as really being a huge growth opportunity for that technology, given the increase in the credit. And the other beautiful thing I believe about CHP is you can kind of use it in combination with all these other technologies that don't necessarily have the ability to provide firm power, and that is solar or small scale wind or other maybe intermittent technologies along with batteries, and essentially build out a sort of a microgrid, if you will. So next slide. The benefits of CHP, talked about a little bit. It definitely reduces emissions. It's going to save you money in a lot of cases, depending on, again, the specifics of your situation. It's very resilient. You talk about backup power at the types of facilities. You guys understand that probably better than any other sector in terms of the need for power, and power that often can withstand ice storms, hurricanes, floods, and most of you would have, backup diesel generation at your facilities. The problem is if these, as we're dealing with various impacts and what seems to be, more severe weather events, is when that diesel fuel runs out and there's still 7-8 feet of floodwater looming about, it's hard to get fuel. If you're using combined heat and power, the gas is coming in through a gas line, you're able to continue running through those sorts of events as we see more and more of them. So a lot of advantages to it. Again, this is a tax credit webinar for the most part, so I'm not going to get much more technical than that. But I would encourage you to look at this technology. Next slide. And again, this just kind of talks about, as a takeaway in these slides, this presentation will be available. Well, back of the napkin, I'm the CFO at an organization. What are 3, 4, 5 metrics that would seem to be of interest if I wanted to look at CHP? So, power costs, reliability, how often are you operating? We can, get to a desktop analysis fairly quickly to say, yeah, this might be really worth looking into. Next slide. A practical example with solar energy. Again, for the folks on the call that are more, responsible for dollars and cents of the organization. If you look to that ITC amount column there, you'll see that ties to kind of the buildup of the credit possibilities and the bonus credits going from 0 to 70. And if you look to kind of that matrix there, it takes the rate of power you're offsetting versus the capital cost of your project, and it kind of looks at a project payback. So we just used a basic example, a megawatt of solar, and every analysis is different, right? But if I just look at it holistically, maybe you looked at a solar project 2 years ago, somebody brought it to you, facilities or someone on the sustainability committee, and you said, solar's really cool, but this thing's not going to pay back for 14 years, and we've got a limited budget, and we need to spend it on things that are more of a high priority. Well, that 14-year payback under IRA, assuming you thread the needle and get to that 70%, or what I call the holy grail of credits, might be a 4-year payback now. Even if you go to 50%, which a lot of projects are going to fall into, you're under a 10-year payback. And this is on solar property, which is essentially a 30-plus year asset. So when I say this can apply to just about any situation, if you've got load, this is kind of what I go back to. Just from a pure economics perspective, knowing there's limitations on capital, knowing there might be certain payback hurdles that you're dealing with, the tools in your toolbox now are substantially greater than they were prior to August of 2022. And, this type of, very simple kind of desktop or benchmarking analysis as it relates to capital deployment, I think is a very valuable exercise and kind of is eye-opening when you look at how powerful the act can be. Next slide. Okay, so we get to our next polling question. Do you have projects planned or underway that you think may qualify for IRA, Inflation Reduction Act tax credits? Yes, no, or you may not be sure, and that's what we're here for. Okay, one other example that I think is going to be prevalent again when I talk about, well, what kind of applies to just about anywhere as a potential economic opportunity? Alternative fuel vehicle infrastructure. There are a great number of incentives for alternative fuel vehicles, whether it be natural gas, electric, renewable gas, but there's also relevant infrastructure credits available for the actual charging stations. So I live here in Austin, Texas, home of Mr. Elon Musk, who, everywhere you look, it seems these days there's a Tesla driving around. He's building his big factory down south of town, and charging stations just about everywhere. If you think this is something that more and more of your constituents, your employees, folks using, whether it be your clinic or staying at the hospitals or what have you, are going to require, appreciate, need, want, now is a really good time to look at that charging infrastructure with the way the world is evolving around electric vehicles. So some beneficial credits, you can get up to 30% of that credit, and that credit for those folks that are part of not-for-profit organizations or non-tax exempt organizations also falls under that direct pay. So you can get a direct payment back from the federal government, 30 cents of every dollar up to $100,000 per charger. So pretty powerful incentive as the nation continues to shift towards more and more adoption of electric vehicles. Next slide. I think, again, just stepping back again, I've talked a lot about the various credits at a very high level and tools in your toolbox. As you can imagine, the CFO level folks, C-suite folks on the phone, you think about how that fits into, how I would traditionally finance a project. We'd be remiss without pointing out that oftentimes there are a lot of state level grants or sometimes other federal grants. Jeff talked about the various buckets on an earlier slide about different buckets of grant funding that are available on a competitive basis. You can pair those in creative ways with the IRA tax credits to offset more of the cost of your project. So it's kind of an exercise, given your situation of, I've got these credits. We know those are entitlements. Are there other grants that may be available at the state level that have come down through the federal government or come from the state? Are there other credits or incentives? Let's just look at the whole picture and figure out the best way to skin the proverbial cat, if you will. So that's a lot of what we do in the early stages. And then, we actually have a team that can help you pursue grant funding if that's of interest, and kind of put this whole, what we call capital stack together. Next slide. Mentioned the tax exempt piece a little bit earlier. As a reminder, thinking strategically, and we work with a lot of tax exempt entities on the municipal government side. So we've got the ability to kind of help you think through, if you're using tax exempt funding, strategic ways to either avoid or at least do a cost benefit of using tax exempt funding if you're going to give up 15%, that reduction I talked about earlier. So just because you're traditionally have used tax exempt financing for most of your capital improvements doesn't mean you have to live and die with it under this construct. So something to just point out again. We're doing a lot of this sort of analysis right now for governmental entities, local towns, villages, cities that have historically used tax exempt, but now they understand that if they use tax exempt financing, they get a bit of a haircut. So what other alternatives are there? Talking a little bit about there may be a question that's arisen on when do I get these credits? The credit is earned in the year you place the project in service. So there's a nuance there relative to financing where think of it as a construction loan on steroids a little bit, where you're going to have your traditional construction loan. And then after the year that project is placed in service, which essentially means generating electricity or doing its intended purpose, April 15th comes, sometime between end of the prior year and April 15th, you file your taxes in theory, and you may not have any income, as a direct pay eligible entity, but you still will be filing some form of a tax return. And then after that time that return is filed, you will get the refund in that 6%, 30%, 50%, 70%, whatever you were eligible for the project. So there's a bit of a lag, again, as you're thinking about funding the construction, and as that construction funding shifts to term, it would kind of go construction financing, term financing, and then likely a buy down of some sort of that term financing with the credit amount. If you're talking about a direct pay, if you're a for-profit entity, you've got options to either use the credit internally if you have tax appetite, or you can monetize the credit. And we could do a whole webinar on monetization of tax credits. We're not going to do much of that today, but just know that if you are a tax-paying entity but don't have the kind of tax appetite or ability to use these credits in a given year, there are mechanisms to monetize them for 90 cents on the dollar, as an example. So happy to walk folks through that. If there's some follow-up questions about as a tax-paying entity, but not having the ability to use the credit, what are my options to get value out of this program? Next slide. I think this is kind of what I talked about previously. You've kind of got to plan around when is the credit going to be earned. The process really is a work in progress. The magic date around all of the guidance on how the credits will get paid, what are my process to apply, what additional strings are attached, what other information will I have to provide. The magic date is around February 12th, which is 6 months after the legislation was enacted, where the federal government basically said, okay, IRS, you guys, here's the rules. You guys got 6 months to figure out how all these rules are going to be implemented. So around 2 weeks from now or so, there's going to be, between now and then, a lot more guidance that comes out. How definitive that will be remains to be seen. What kind of requirements will they have as, for entities that are looking to file returns for direct pay, for non-direct pay. Stay tuned, I guess, is the message on that, but you probably won't have to stay tuned very long as that 6 month window or internally imposed deadline is upon us. Next slide. Jeff, do you want to go to recommended actions and then get to the next polling question?
I will, Joel. And just a general question, Joel. If an organization had started construction before the date that RIA was signed into law, do they still have the ability to take advantage of these credits if it wasn't put in place till after?
They do, and that's a great question. And there is actually a specific definition for certain credit under IRS rules on what begun construction truly means. That has historically been more in place to lock in credits or lock in. There was some begun construction language around, locking in or a safe harbor around prevailing wage and apprenticeship. But in terms of I think the question you're asking is, by and large, it's all about when you place a project in service versus when you have started construction. So if you think, well, federal government's not going to give me a credit because they're thinking I was going to do this project anyway, that is not necessarily the case. There are some nuances if you're using tax-exempt funding as to that 15% haircut I talked about, that if you were going to use tax-exempt financing and you feel like you started construction, however you're defining that, prior to the enactment, we'd want to speak, in more detail about what actions we're taking. It's not gonna prevent you from claiming a credit. It just may impact your ultimate amount that you'd be able to claim. But by and large, This program is all about when a project is placed in service for purposes of claiming a credit versus when you started, even if when you started was before the implementation of the act. Great question, and a very common one we get. So the devil's always in the details, but generally speaking, you're still in good shape, even if you started before August on your project. And happy to chat with folks about the specifics, but you should not forego the idea that you would have an opportunity for any of these credits just because you started before the middle of August.
Thanks, Joel. That's a great answer to that. Okay, so what are the recommended actions for our healthcare organizations and for pretty much all organizations that are out there? First is evaluate your organization's deferred maintenance plan for projects that involve energy efficiency, renewable energy, or other eligible components under the Act. Like I said, it could be prior, current, or future projects. Second, you want to understand the value of direct pay tax credits now that they are available to tax-exempt organizations and other organizations that may not have had these available to them prior to the Act. Third, you want to refresh feasibility assessments on potential projects and put a development plan in place for those you wish to move forward on. You may want to change how you move forward on them. You may want to, maybe you didn't have the energy efficiency components in there. Now you could definitely put those in now, and it could pay for part of the project that you're doing. So we definitely recommend that you look at your studies, your maintenance plan, etc. Also, we would work with facilities team to create a funding strategy, both related to the project financing and ESG related considerations, environmental governance, social and governance considerations. A lot of organizations have stepped up these programs, and these energy efficient credits can tie in well to your ESG strategy. And also that you should contact your Baker Tilly person you work with, or myself or Joel, and we can talk through some of these things with you, get the right people on the call from our side to your facility side. Could be CFO, COO. There's just a lot of people that from each organization that should be involved to determine what's the best way to move forward with these projects, and make sure when you're doing the construction contract that these terms and conditions are in the contract. So that's some of the things we'd recommend. And finally, just keep in mind when you're doing something, you're paying money for something, step back and say, hey, should I be looking at this differently because there might be a credit available to the organization? And as we all know, healthcare organizations may not be the best funded organizations from government payers, etc. And if you can get some more money in the door into your coffers, then you should do that.